Welcome back to the Talking Hedge. I'm Josh Kincaid, capital markets analyst and host of your cannabis business podcast. Today, we're going to take a look at cannabis funding in 2020. There's been fewer raises, but bigger numbers. Before we get into that article, a couple other things just to highlight the whole point. MJ Business Daily talks about Acreage Holdings securing $100 million in debt to fund marijuana growth. So publicly traded company has to go and secure additional $100 million from an institutional investor, essentially a bank, in order to remain in operations rather than doing that from revenue. So definitely a tighter lending environment. People have been battered down with stocks and just kind of waiting for maybe some companies to collapse or at least to start producing revenue. So this is an interesting transition, I guess, to take debt similar to Cureleaf and Cresco Labs. So Aurora got rid of their CEO and then had a $1 billion write down. That's a lot of money to write down. So when your valuations were too high or when your expectations were too high, you have to just kind of write that off. And so that's a lot of money. I'm sure there's going to be more shareholders that are holding people accountable than just Aurora, but that's a lot, $1 billion. So looking at Tetra Bio-Pharma, they finalized a bought deal financing. So a bought deal financing is when you're about to go to an IPO and syndicate members, which are your underwriters, people that are trying to find financing, when they buy shares from you pre-IPO, that's essentially a bought deal financing. They're front running. They're buying it before anybody else does because they potentially see some value from somewhere. So there are deals being done. And yet Cansortium is planning to exit from the Colombian marketplace. So we've talked about this before. They're not the first ones. Other companies have exit the Colombian marketplace. And so it doesn't really make sense from a traditional agricultural standpoint. When you have terroir in Colombia with inexpensive labor, you should be siloing that, continue to grow it, make extracts or products for the Canadian import and eventually European export market, all from Colombia. So the fact that they're not doing this is a red flag to me. There's either something happening in Colombia preventing them, or they're just having to sell off decent assets or not pay for their operations in Colombia. It doesn't really make sense. So if you've got any ideas on how this makes sense, leave a comment, because traditionally, from an agricultural standpoint, this doesn't make any sense. They're going to hold 50% equity in the Colombian operations, but processing cannabis and growing, manufacturing and everything is going to cease. They say that they're going to be laser focused in Florida, Texas, Michigan, Pennsylvania, all potentially lucrative, being that they're maybe not even medical yet in some cases. Hopefully going rec like Michigan, but Texas they don't even really allow CBD. So the company undertook a $4.6 million private placement. They restructured $25 million near-term obligations for their core assets in Canada and Puerto Rico. We talked a lot about Puerto Rico being the only place in the world an American business, an individual can go and not pay federal corporate taxes. That's because they don't have congressional representation. You can't have taxation without representation. So that's why Puerto Rico is the only place a business can go and survive. My opinion, 85% of companies that are involved in CBD will not be in business unless they have an entity in Puerto Rico taking advantage of 4% corporate tax cap, 50% tax credits, 100% tax exemptions in some cases. So smart on them to at least try and continue that operations in Puerto Rico and Canada. It looks like they're prioritizing that. But according to Bloomberg, several cannabis companies just have a couple of months worth left of cash. There's a lot of Canadian cannabis producers that have a median of just 6.5 months worth of cash. So their burn rate is excessive. And that's why a lot of these people or companies are either selling their assets or doing sale leaseback options to where they can rent it but not own it. So definitely a shift on a lot of these companies as their burn rates are just way too high. So Aurora has the worst cash position of any Canadian producer. They have 2.3 months of liquidity. Tilray has 3.7 months, so they aren't too far behind. Aurora announced that it's going to be cutting 500 jobs as part of this cost-cutting effort and announced that the CEO would be stepping down. This is ultimately going to spike that M&A position because a lot of these companies aren't going to be able to survive unless they cooperate. So on the producer-processor side, the co-op model or just merging, finding partners to remain a going concern, that's accounting speak for staying in business. So a huge appetite for mergers and acquisitions or M&As. Altria taking a $1.8 billion stake in Kronos Group last year. That's a big deal. There's also a switch in management teams. Obviously, a lot of CEOs been left behind, let go. I mean, so that's the switch. They're looking to benefit the industry with more professional C-level teams, tighter operating experience, and that type of environment. So for a lot of these companies that don't have profitable SKUs, that like Curaleaf, when you have $800-900 million valuations for something that's really not generating the revenue to support that valuation, there's going to be restructuring. CEOs are going to be let go, and there's going to be more write-downs, and a lot of these shareholders are going to start holding people accountable. So let's take a look at the cannabis funding. There's been fewer raises and bigger numbers. In terms of capital raises, there was a strong last week with 3 large cannabis companies announcing $425 million in funding. Although the number raised was down, the average raise rose to $66.8 million from just $15.9 million. Publicly traded companies represent 6 of the 7 capital raises, demonstrating that even in a depressed stock price environment for public cannabis companies, investors will still chase liquidity. Since the origin of the Viridian Cannabis Deal Tracker in 2015, public companies have attracted approximately 2/3 of all invested capital. So cultivation and retail sectors remain the dominant sector for investors as the capital markets continue to support the build-out of infrastructure required to scale up and bottom line. So from 2015 to 2018, cultivation and retail accounted for 75% of all capital raises. However, last year, this dropped to 55%. Makes sense. People don't really want to touch the flower. A lot of that is because it's a commodity. It's a race to the bottom. You can see that in other industries. Coffee, look at Starbucks as a history. Even Amazon with diapers in the Northeast. There's a particular company that wouldn't sell to Amazon. Amazon dumped their prices until that company went out of business, and then they raised their prices back up. Just like Starbucks. They'll lower their prices in a neighborhood, wait for mom and pops to go out, then raise their prices back up. It's corporate America, capitalism, I guess. I think a lot of people believe this is altruism and a medical product when really this is going to be cutthroat. So as people shift from plant touching the commodity, they're going towards brands and finished products, infused hemp, which is CBD probably, and consumption devices, probably technology, accurate dosing. So hemp and CBD sectors experienced a significant private market raise of $40 million from Ecogen Laboratories, increased investment in the hemp sector. So for mergers and acquisitions, there was only one closed acquisition. High Tide purchased 2 dispensaries by acquiring a major interest for a mix of stock and cash. Yeah, probably more stock than anything. And so a lot of misconceptions about these high numbers. Oh, $2 million for something. And really it was just stock. So there's a gradual uptick in M&A activity based on just a few factors. So they're predicting a gradual uptick in mergers and acquisitions activity based on a few factors in the marketplace. The number of mergers and acquisition transactions that are in the LOI stage, a letter of intent or a MOU, memorandum of understanding, is basically an agreement that if something happens, we'll do that. I steer clear of those, caveat emptor, wouldn't even touch that with your money. So the other uptick in M&A is going to be based on aggressive activity in the part of special purpose acquisition corps. Those are basically blank check companies. They raise $1.2 billion and are looking at buying something. And then the final piece of why there might be M&A uptick activity is drastically reduced valuations. So the valuation expectations from private companies are having huge difficulty attracting new capital as a result. They're looking for an exit. Absolutely, I would double down on that. People are looking for value. The speculation, that game is over. They're looking at real money, real revenue, real companies. And your LOI, your letter of intent saying, hey, give me money and I'll go do this. I'll build a grow room. I still get investment decks from people that want to grow. And that's crazy. I think we've already seen that. That's over. We have enough land. And I understand that there's not interstate commerce yet. But to ask for millions of dollars to grow a commodity when your expectation is that you think you're going to get $7,000 a pound is insane. And there's a lot of people who think that they're going to get, $13,000 for a water soluble isolate or $7,000 for THC flower, in Philly, New York. It's just crazy. They think that those legacy markets, the illicit market prices are going to remain, and it's not even close. In terms of burn rate, looks like Tilray has about 4 months. MedMen has about 7 months, along with Hexo. Canopy is about 8 months, and then Harvest close to 9 months for liquidity. So the burn rates are excessive, and unless something happens, they might not be around. Only time will tell. So with that, we're going to roll this one up. I'm Josh Kincaid. This is the Talking Hedge. Don't forget to like, share, and subscribe, or don't, and I'm out.